Good morning, everyone. Welcome to Nobles NRI Taxation. Myself, CA Asha. Today's webinar is all about tax planning and compliances for salaried individuals with multiple heads of income, foreign investments, and individuals who receive ESOPs or RSUs as a part of their salary component. In today's session, we will be discussing about residential status and tax rates applicable for the individuals and the various heads of income. Finally, we'll also have a look into the tax compliances and disclosures to be taken care while filing your ITRs in India. Disclaimer, please don't consider this webinar to be a tax advice. This is only for general use. The taxation may vary from client to client on the basis of their heads of income and on the basis of their past year returns. So please just consider this webinar for a general use and not as a tax advice. Residential status, tax rates, and advanced tax. First, we'll discuss on these things, and the next we'll go to the heads of income. So, residential status in India, the residential status of an individual is determined on the basis of number of days of stay during the current financial year and in the preceding financial years. Current financial year is 1st of April 2025 till 31st of March 2026. So, during this period, you earn the income and for the income earned in this current financial year, you're liable to file your returns in the next year. That is called as the assessment year. And assessment year will be 1st of April 2026 till 31st of March 2027. So in India, the residential status is classified into three: resident and ordinarily resident, also known as RORs. For such individuals, the global income is taxable, and he or she is liable to disclose all their foreign assets in India. Second is resident, not ordinarily resident, also known as RNOR. The income accrued and received in India by such individuals will be taxable, plus certain foreign income, if they arise from a business or profession controlled from India, is also going to be taxable for such individuals. RNOR status is also known as a transitional phase because during this status you are neither a resident nor a non-resident. So this phase allows you to do some tax planning, whether you want to continue with your investments outside India or you want to redeem and have all your investments only in India. So during this time frame, you should be doing all these tax planning because only the Indian income is going to be taxable for you in this phase, and whatever income you earn outside India, you will be liable to file your taxes in the respective country. Usually, RNOR status continues for at least 2 years. So, once you come back to India, at least for 2 years, your residential status is going to be RNOR, and from the third year onwards, you might become a ROR. And at that point of time, all the additional compliances will come into picture. Finally, the third status is non-resident, also known as NR. In this status, your income accrued and received in India is only going to be taxable. So the residential status is determined on the basis of a few conditions. There are there is a set of two basic conditions which determines whether you are a resident or non-resident. And in case you are a resident, then we need to look into the two additional conditions to further classify the status to ROR or RNOR. So the residential status conditions are resident or non-resident is determined on the basis of the basic conditions. So if an individual is resident in India in a financial year, they have to satisfy either of the following conditions. He or she must have stayed in India for more than equal to 182 days during the financial year, or stay in India for more than equal to 60 days in the financial year plus more than equal to 365 days of stay in the four preceding financial years. So the total of more than equal to 365 days in the four preceding financial years. So either of the conditions satisfied, the person will be treated as a resident. Otherwise, he or she will be treated as a non-resident. Next is once a person becomes resident, we need to check the additional conditions to determine whether he or she is a ROR or RNOR. So a resident can be ROR if they satisfy both the following conditions. resident in India in 2 out of 10 preceding financial years, which means as per the basic conditions, we have to check whether he or she was a resident in India in any of the 2 out of the 10 preceding financial years, and parallelly stay in India for at least 730 days in the 7 preceding financial year. He or she must have stayed for at least 730 days in the 7 preceding financial years. So if either of the above conditions are not satisfied, then our residential status is going to be RNOR. Otherwise, a person, if both the conditions satisfied, the person will be ROR. Going to the next slide, it's about the slab rate, which is applicable under the new regime. So, as per the previous year's budget, the slab rate was updated, and here is the is a new slab rate which is applicable under the new regime for financial year 25-26. So, up to 4 lakh, there will be no taxes, and then cumulatively there is an increase of 4 lakh, and at the same time, parallelly, 5% tax rate will also be increasing. So, in that case, when your income is exceeding 24 lakh, that's when 30% tax rate is applicable. So when we compare this with the old regime, as in when your income exceeds 10 lakh rupees, the 30% slab rate is applicable. So under new regime, there is no deductions or exemptions available. Uh, only standard deduction of 75K is available, and any contribution done by the employer to your national pension scheme will also be allowed as a deduction. So these are the only two standard deductions which is available. Interest on housing loan on a self-occupied property is not allowed, but interest on housing loan on a let-out property will be allowed under the new regime. uh, if an individual who is have a salaried individual with an income of less than 12 lakh 75,000, then there won't be any tax liability for the person. Over and above the income tax rate, there is also something called a surcharge rate, which we'll be discussing in the subsequent slide. Surcharge rate is applicable if your income is exceeding certain limits. The surcharge rate will be applicable. And next is health and education cess, which is applicable for all the individuals, irrespective of their nature of income. So, health and education cess is applicable at the rate of 4% on income tax plus surcharge. On this amount, the education cess of 4% will be applied. So here is the slab rate under the old regime for financial year 25-26. There is no change in the slab rate from past few years on under the old regime. Under old regime, all the Chapter 60 deductions, HRA, LTA exemptions, self interest on housing loan up to 2 lakh rupees, all these exemptions are allowed. For an individual with income exceeding 24 lakh, he or she must have at least an exemption of 7.75 lakh, then only old regime is going to be beneficial. If he or she has an exemption of benefit of less than 7.75 lakh, it will be the new regime which is going to be beneficial. Surcharge rate applicability. Surcharge is basically levied on income tax if the SSC's income exceeds the specified limits. So the limit is surcharge will first be applicable if your income is exceeding 50 lakh rupees. So if your total income exceeds 50 lakh rupees, but if it is less than 1 crore, the surcharge rate will be 10%. If it is exceeding 1 crore but less than 2 crores, surcharge rate will be 15%. If it is exceeding 2 crores but less than 5 crores, surcharge rate is going to be 25%. 25% is the maximum surcharge rate applicable under the new regime. In case a person has opted for old regime and the income is exceeding 5 crores rupees, then in that case the surcharge rate is going to be 37% under the old regime. And maximum surcharge rate is limited on capital gain and dividend incomes. The surcharge rate, there's a cap for income, capital gain and dividend income. The surcharge rate on such incomes is going to be 15%. It is not going to be the higher rate of 25% or 37%. So it says that there is a cap inserted for this particular income. Advanced tax installments. Now, advanced tax is payable by a person when whose tax liability exceeds 10,000 rupees. So, when I say the tax liability, this is the net tax liability after excluding the TDS, TCS, and foreign tax credits. Still, if your tax liability exceeds 10,000 during that particular financial year, you're liable to pay advanced tax. In case of non-compliance of advanced tax, interest will be levied under Section 234B and 234C. The due dates for advance tax is mentioned here. Uh, Advance tax has to be paid on a quarterly basis. Every quarter on 15th, the advance tax will be due. It will be due. So it is like on 15th of June, 15% of the advance tax has to be discharged. By 15th September, 45% of the total advance tax liability has to be discharged. By 15th of December, balance 75% of the advance tax liability has to be discharged. And by 15th March, 100% of the tax liability has to be discharged. So, so basically, the rental and interest income, etc., when you're earning, on that advance tax has to be computed. Like we need to forecast those incomes and for the entire year, and we should consider that in our tax computation. But when it comes to dividend and capital gain, the taxability arises only on actual receipt basis, and so as and when the realization happens, that's when you're supposed to consider or include that in your advanced tax computation. So both Indian and foreign income has to be considered for the computation by RORs. Interest under Section 234 B and C on non-payment of advance tax. In case an individual does not comply with the advance tax provision, interest is levied at the rate of 1% per month under both these sections, that is 234 B and C. 234 B says at least 90% of your tax liability, advance tax liability, should be discharged. In case of short payment, uh, interest will be levied at 1% per month from the beginning of the from 1st of the April, that is from the assessment year beginning till the date of payment. And Section 234C says on if you don't comply with the installments, that is as 15%, 45%, 75%, and 100%. If that criteria is not met, if the advance tax is not paid as per within the due date as per the percentage is fixed, in that case, interest will be charged at 1% per month on the amount of default for a 3-month period until the next installment is due. Now let's move on to the various heads of income applicable for an individual. Individual can have salary, rental income, capital gains, and income from other sources. When it comes to the salary, Form 16 is the key document which is provided by an employer. Form 16 offers the breakup of the taxable income and the tax deducted by the employer during the financial year. The timeline to issue a Form 16 by the employer is by 31st of May, that is within 2 months from the end of the financial year. Many a times, department provides extension for the issue of Form 16, and that's why there is a delay in providing Form 16 by the employer. In case there is a delay in Form 16 being received from the employer, we can also proceed with the tax computation with the help of March month tax statement, which is easily available in your payroll portal along with the March month payslip. The next key document is the EPFO passbook. So, 2 years before, there was a amendment in the EPFO contribution rules. So, an employee who contributes in excess of 2,50,000 rupees to the EPFO account, in such scenario, the interest earned on such excess contribution will be taxable for the employee. And if the interest amount exceeds rupees 5,000, TDS will also be deducted by the EPFO department. So, in the given case, we need to look into the EPFO passbook to ensure that the disclosure has been given accurately and we have offered this income to taxes. So EPFO passbook acts as a supporting document. So in the recent passbooks that we downloaded, we also noted that there are two splits given. One provides a breakup of employee contribution, employer contribution, and the pension contribution in the EPFO. Secondly, we can also get a breakup of the taxable and non-taxable EPFO contribution, and the tax interest amount is also mentioned in the EPFO passbook itself. So this will be the key supporting document. Secondly, if you are someone who receives RSUs as a salary component, then the tax part will be already taken care by the employer, which means it will be treated as a perquisite and taxes will be deducted by the employer at the applicable slab rates. In case the RSUs are being issued by RSUs pertains to a foreign company, then such RSUs must be disclosed under the foreign asset disclosure part. And if any dividend income has been earned from such RSUs received, that should also be offered to tax under the head income from other sources. When these RSUs are redeemed, the taxability will be under the head capital gains. Next is declaration. So, usually, when the financial year begins, that is in the month of April, a declaration form is released by the employer. In this declaration, many a times the employer also offers to provide other income details, which means you can mention your interest and rental income as well in such declaration, so that you can reduce your burden with the advanced tax computations, and the tax TDS, necessary TDS deduction on such incomes will be done by your employer itself. An individual who has opted for new regime, there is no submission of proof required, because under new regime only two deductions are available. One is standard deduction, and second one is the employer's NPS contribution. So these two are the deductions which is available. So there is no supporting document required uh, for any other items. But if you are someone who are opting for old regime, or you have given at the year beginning in your declaration you have selected old regime, then you have to submit the required proofs during at the year end, that is in Feb and March. Next is rental income from house property. An individual who has given his property on rent will be receiving this income. Such income is liable to tax. The following expenses will be allowed as a deduction. Municipal tax paid during the year will be eligible to be claimed as an expense. Flat 30% standard deduction is eligible on the total rent received. Interest on housing loan, if any housing loan was incurred and any interest has been paid towards such loan during the year, that is eligible to be claimed as a reduction. Pre-construction period interest, if any, is also eligible to be claimed as a reduction, which means the property was under the construction phase and now you have received the possession. So till the date of possession, whatever interest was incurred will be eligible to be claimed as a reduction once the property is given on rent. And such interest has to be distributed over a period of 5 years. So you cannot claim the full interest in the first year itself. In the 5 years from the date of possession, such interest amount is eligible to be claimed as a deduction. Next, we'll be discussing about capital gain. So capital gain is classified on the basis of holding period. So as per the latest budget, that is budget 2025, the holding period has been classified into two, 12 months of holding period, and all the other capital assets will be having 24 months of holding period. So Indian listed equity shares and equity oriented mutual fund, for this, the holding period is going to be 12 months. So, on the basis of the holding period, we have to classify whether the income earned, that is the capital gain generated from this asset, is short term or long term. If this is held for more than 12 months, it will be classified as long term capital gain, and long term capital gain is taxable at the rate of 12.5%. And if it is held for less than 12 months, it will be classified as a short term capital gain and taxable at the rate of 20%. Apart from the listed equity shares and equity oriented mutual funds, any other capital asset, the holding period will be 24 months. When I refer any other capital asset, this includes immovable properties, foreign securities, liquid funds. So all those assets will fall under this category, and the holding period should be 24 months to classify it as short term or long term. So from such assets, the long-term capital gain on such assets will be taxable at the rate of 12.5%, and the short-term capital gain from such assets will be taxable at slab rate. So if you're coming under the 30% slab, such incomes will be taxable at the rate of 30%. So as per the latest budget, the indexation benefit has been completely removed. There is no indexation available. Now let's discuss on the various exemptions available on sale of certain capital assets. So section 54, 54EC and 54F deals with the exemptions. In these sections, it specifies certain capital assets which has been sold, and the amount realized on sale of such a capital asset should be utilized to purchase certain assets within the timeline specified under these sections. In that particular case, the capital gain book will be exempt, which means there won't be any tax liability on such income earned. So first is section 54. Section 54 deals with residential house property, which means you have sold a residential house property. You have utilized the amount on sale of such residential house property to purchase another or new residential house property in India. In such given case, if the amount is utilized, the capital gain booked on such assets will be exempted. There is a lock-in period of 3 years, which means for 3 years you are not eligible to sell this property. In case you sell the new property within 3 years, the capital gain exempted will be taxable in that particular year. The investment has to be done within the time limit specified. If the amount is not utilized within the timelines, then this amount has to be kept in a capital gain account scheme. Next section is section 54 EC of EC. Uh, Under this, the long-term capital asset that is being sold can be a land or building. The new asset that has to be purchased is bonds notified by the central government. Such investment in bonds has to be done within 6 months of sale or within the date of tax filing, whichever is earlier. The maximum exemption that is available is up to rupees 50 lakh. That up to 50 lakh rupees you can make the investment. And the lock-in period is 5 years, which means for 5 years you cannot withdraw the amount invested in these bonds. Next and the last section is section 54F. In this given case, the asset that is being sold, the long-term capital asset that is being sold is it can be any asset other than a residential house properties, which means shares, securities, bonds, etc. So it has to be a long-term capital asset other than residential house property. And the new asset that you're purchasing on redemption of the security should be a residential house property in India. In case the amount is not utilized within the timelines of filing of your ITR, the amount should be deposited in the capital gain account scheme. And the exemption is available. The maximum amount of exemption is calculated proportionately to the amount of investment made in the new asset. The timeline is 3 years, that you cannot sell the new house property for a period of 3 years. After 3 years, you are eligible to sell the property. In case you sell the property prior to 3 years, the exemption or relief received will be taxable in the year of sale. Lastly, we'll be discussing on income from other sources. So this includes all the other types of income like interest from PF, interest from FD, interest from savings bank account, dividend income earned from Indian securities as well as foreign securities. Income from others, all the incomes under the income from other sources category will be taxable at slab rate. Indian interest and dividend will be reported in your EIS. So this has to be ensured to be considered. In case a person is making joint investment, the incomes are always reported in the EIS of the first holder. So there can be some tax planning done over here when you're making your investments. Even in the case of capital gain on securities, whoever is the first holder, the income will be taxable for that person. Dividend income earned by a non-resident will be taxable at a special rate of 20%. And on the securities part, here, as I have mentioned, like capital gain from listed securities, on the long-term capital gain earned on listed securities, there is an exemption of 1,25,000 rupees, which means up to 1,25,000. Unique on the realized gain of 1,25,000, there won't be any tax implications. Any gain exceeding 1,25,000 is going to be taxable. So these are all the heads of income. Now let's discuss on disclosures and filings. So as and when we are filing our ITR, there are multiple things which has to be taken care. There are various disclosures which has to be given. There can be some additional forms which is required to be filed to claim certain exemptions and deductions or to claim the foreign tax credit. So we'll be looking into that details now. First is RSU disclosure. So RSU or ESOP is a form of equity compensation which is offered by a company to its employees. This is taxable as a salary perquisite once exercised by the employee and taxable as a capital gain when sold by the employee. RSUs are RSUs when issued by a foreign company like Google or Amazon. This needs to be disclosed under the foreign asset disclosure. Filing of Form 67. So basically, for a resident individual, the global income is taxable. So the foreign dividend income, etc., whatever he is earning, if there's any withholding of taxes, that withholding of tax can be claimed as a credit in India. So when he or she offers the dividend income in his ITR, correspondingly the foreign tax credit can also be claimed. The taxes paid outside India can also be claimed as a foreign tax credit in India. To claim such taxes, Form 67 has to be mandatorily filed. This has to be filed within the ITR due date and before filing of the ITR. Foreign asset schedule. Foreign asset disclosure is mandatory for a individual who is ROR. Financial assets like bank account, savings account, checking account, FD account, brokerage accounts, 401k accounts, and any kind of immobile property outside India needs to be disclosed under the foreign asset schedule. Other foreign assets like insurance policies, trust, partnership, or business entities outside India should also be disclosed. On non disclosure, the penalty is huge. It can go up to 10 lakh rupees and an imprisonment of more than 10 years in case of willful omission. 1099 and 1042 is are the key supporting documents. Even if your income is less than the basic exemption limit, but if you have any kind of foreign asset, it's mandatory to file the ITR. Holding 401k account. So an individual who was a non-resident, which means he was working in US, he will definitely have a 401k account, which is a retirement savings plan in the United States offered by the employers to their employees. Such 401k account should also be disclosed under the foreign asset disclosure. Any income accrued in this account, like the dividend or capital gain, must be disclosed in the ITR. Corresponding exemption can be claimed under Section 89A while offering such incomes. If 89A exemption has been claimed, Form 10EE has to be mandatorily filed to claim such exemption. This amount will be taxable only on withdrawal. That is, it can be withdrawn either on retirement or even prior to that. When withdrawn on retirement, the 10% penalty will not be imposed on such account. But if it is withdrawn prior to that, 10% penalty will be applicable on such withdrawals along with the taxes withheld. Form 10EE is used to claim exemption under Section 89A of the Income Tax Act. IRA or the retirement account held in US, Canada, and UK can be disclosed and exemption can be claimed towards them. Dividend or capital gain accrued in this account. Tax liability on this is deferred under this section. Taxable only on actual receipt basis. So the income is taxable only when actually the amount is received and not when the funds are switched from one fund to another within the 401k account. Asset and liability schedule. If your total income is exceeding 1 crore, it's mandatory to disclose all your Indian plus the foreign assets as on 31st of March. This has to be disclosed at cost. Unlisted share disclosure. It's mandatory if you have invested in any unlisted companies in India. This must be disclosed in your ITR, including this will include details of acquisition, sale, and the closing balances. With regards to the ITR filing, the due date for filing the ITR is 31st July of the assessment year, unless it is extended by the department. As we saw for the last financial year, it was extended till 15th of September 2025. Original return filed within the due date can be revised, which means a return which is filed within the due date is called as the original return. If you will get to know that there was some error or you have missed out or there was some omission of certain income, then you can revise the ITR. The timeline to revise an ITR is by 31st December of the assessment year. Such revision is called as the revised return. In case you have missed out to file your return by 31st of July, you can still file your return on or before 31st of December. Such return is known as a belated return. Mandatory filing is required in the below scenarios. If you have any kind of carry forward of losses, like you have redeemed your securities at a loss and you want to carry forward those losses, then you must be mandatorily filing your ITR. If you are having any foreign assets, you must file your ITR to disclose that foreign assets. If you want to claim your income tax refund, which means the taxes deducted is higher than what you're liable to pay. In such case as well, you have to file your income tax return. Then only you can claim your income tax refund. And if you want to claim any kind of exemptions that we discussed, like 54, 54, F54 EC and all, that's when you have to also file your return. Belated return can be filed with late filing fee of rupees 1000 or 5000 depending upon your income limit. And the belated return can be filed by 31st of December of the assessment year. The consequences of a belated return is FTC claimed in a belated return is subject to litigation. If suppose you are someone who are liable who can claim the foreign taxes, and if you file a belated return, we can file with this deduction, that is we can claim the section 90 deduction, but still it is subject to litigation. We cannot assure that the foreign taxes will be allowed by the income tax department. If you have any kind of losses, it cannot be carried forward in a belated return. Even in the past, if you had any losses, you have to file your return within the due date. That's when you can carry forward the losses. If you miss out to file your return in 1 year and then later on you're filing your return, the losses which was eligible to be carried forward will not be eligible anymore. If you want to file your if you want to get the benefit of selecting the regime, that is you want to choose whether to select old regime. If you want to file under old regime, you must have filed the return with original return within the due date. If you're filing it late, by default it will be new regime which will be selected. Thank you once again for joining today's session. Hope this was helpful for you. If any of these areas apply to you, we are here to assist you. In Nobilis, we offer the following services. First, as an ongoing service, we have advisory, where we provide personalized guidance on optimizing deductions and structuring the income. Secondly, we offer advanced tax computations, that is timely calculation and planning of advanced tax liability. This will help you to eliminate the interest component under section 234B and C. For the current financial year, still two quarters are left, that is 15th December and 15th March. If you need our assistance, we can assist you in the advanced tax computations, and we can reduce the tax interest component for at least by making the advanced tax payments at the right time. Thirdly, ITR filing and end-to-end support is provided for accurate and compliant filing. Next, we offer advisory services. We offer advisory services to returning NRIs. That is, we provide strategic planning during the RNOR phase, where an individual is neither a resident nor a non-resident. During this phase, we guide them whether they can continue with the investments in India, or they should continue with their investments outside India, and till what time they should continue, till by when their status is going to change, and by when they have to comply with all the disclosures and the advanced tax compliances and foreign tax credit. So we do provide advisory for returning NRIs. Then we do advisory on CG exemptions, that is exemptions under section 54, 54F, and 54 EC. We provide them, we address the issues like which is the right asset to be redeemed at what time, and how they can utilize these exemptions in the best possible way. 401k advice is also provided, like DTWA based planning for the US retirement account is given by us. Finally, we offer past year analysis and support as well. Like in case any rectification or revision is required, we can assist you in that. Any support in addressing the notices by visiting the department, etc., we can assist you in that as well. If you would like to explore any of these services further, feel free to reach out. We will be happy to assist you. Here are the contact details. You can send an email to nobilis at nritaxation.com.in or to admin at nritaxation.com.in. You can also message us in WhatsApp or give us a call in this given number 9606 939 758. Hope the session was helpful for you. Let us know if you need any assistance. We are here to assist you. Thank you.